Hi, this is Michael Joyce from Agili, and I'm pleased to share with you our thoughts and viewpoints for the spring of 2019. The quarter that we just finished up on March 31st was really a banner quarter, which was a good thing because we had a nice correction in the prior quarter, but things have recovered quite nicely since then. So despite the fact that the markets are really doing quite well, there seems to be a lot of angst in the markets and in the financial press. And one of the things that's been talked about a lot lately in the financial press is this phenomenon about the inverted yield curve. Now, I know that all of our YouTube followers have been just begging for us to talk about the inverted yield curve. So here it is. So what is an inverted yield curve? Well, typically the Treasury bond yield curve is positively sloped. That is, the longer the maturity, the higher the interest rate, which makes sense because there's more uncertainty in the long term than there is in the short term. But right now we're experiencing a phenomenon called an inverted yield curve, which means that shorter term rates are actually higher than long term rates. And over the years, an inverted yield curve has been an excellent predictor of a recession. It doesn't always happen, but mostly it does. But the thing is, it doesn't mean that there's going to be a recession tomorrow or next month. Typically, it means there's going to be a recession maybe a year and a half or 2 years down the road before we even start to see a decline in economic growth. And in the meantime, what often happens is the markets do quite well. I mean, if we look back to 1998, there was an inverted yield curve, and the markets did really well during 1998 and 1999 and into 2000, and albeit with higher volatility at that period of time. The mother of all inverted yield curves was back in 1981 in the early 80s when Paul Volcker was the head of the Federal Reserve. Now, if you remember, this was not the good old days for the economy. We're experiencing double-digit inflation and really lackluster economic growth. So Paul Volcker was determined to break the back of inflation, so he increased short-term interest rates very high. The prime rate got up to 21.5%. At that period of time. And that really did the trick. You know, inflation has been really on the decline since then. And when we've had inverted yield curves before, it's always been because the Fed is trying to fight higher inflation. And I hate to say things are a little bit different this time because I hear that a lot, and you know, history may not repeat itself, but it often rhymes. But this inverted yield curve is a little bit different because it's not caused by the Federal Reserve fighting inflation. Inflation is very low right now. Inflation is running right about the Federal Reserve's target, a little bit over 2%. But the Fed has raised interest rates over the past 2 years to unwind some of the quantitative easing that they did earlier in this decade. So now they've raised short-term rates to the level where they should be in normal times. It's about the rate of inflation. So the inverted yield curve right now is not anything to panic over, but it's something to keep an eye on. And that's certainly what we're doing. I mean, we're still in the mode that we don't think it's yet time to get defensive, but it is a good time to be a little bit more cautious, be a little bit more careful, focus a little bit more on quality. What we're also going to have very shortly is the tax filing deadline for taxes. So I just read an NBC Wall Street Journal poll that showed that only 17% of all Americans think that they got a tax cut, when in reality about 80% of Americans are paying lower taxes due to the new tax bill. Because remember, 2018 is the first year that we're going to be under the new tax bill, the 2018 filing year. So why is there this disconnect? Well, one of the things is that around the time that shortly after the tax bill was passed, there was a change in withholding tables so that people would get to keep more in each paycheck. So what has happened, and there's been a lot of angst in the financial press about this, is that people are getting lower refunds. And the reality is getting a lower refund is actually better. It's better to get your money earlier. If you're getting a big refund, in essence, you're giving the U.S. government a big interest-free loan. But a lot of us are going to get tax refunds. So what should we do with those refunds? Well, One of the things you should look at doing is to make sure that you have a sufficient emergency fund. You know, there's going to be times where we have extraordinary bills. It could be a medical bill, it could be a large repair to a car or something like that, and you want to be able to have the funds to be able to pay those bills. A second thing is paying off some debt. Now, we've talked in the past about good debt and bad debt. So what we want to get rid of is some of the bad debt. So if you're carrying credit card balances, knock those out. Car loans, you know, unless it's one of those 0% loans or practically 0% loans where basically the car dealers are giving you money, knock those out too, because cars are depreciating assets. Same thing with boat loans, if you happen to have a boat loan. So if you make sure that your emergency fund is in good shape and you pay off all the bad debt, what we would strongly encourage you to do is to increase your retirement savings. Increase your contributions to a company-sponsored plan like a 401k plan, or put money into an IRA or a Roth IRA. And your financial strategist at Agili would be happy to help you with something like that. So I've been very pleased to share with you our thoughts and viewpoints for the spring of 2019. If you have any questions, feel free to contact your financial strategist at Agili or to contact me. You can also find out more about what we're thinking by going on our website, agilipersonalcfo.com, or to follow us on Twitter. Thanks. Have a great day.